Yeah, welcome everybody. My name is Scott Fuller, founder of Leaving the Bay Area and Leaving SoCal. We've got a great program for you today. I'm very excited because we're not only talking about Prop 19, but I'm excited about our guests who are going to be really helping us dive into more about what Prop 19 is. Boy, there's some good and bad with this, right, guys? I mean, some people are like, this is fantastic. And some people are like, what do I do? And so I think what we're going to try to do is just, give a very, very good overview of what Prop 19 means from a couple different perspectives. I do have to preface by saying that this should not be construed as tax or legal advice. We are looking from a 30,000 foot level, but if you need to drill down into what your personal financial or legal situation looks like, please talk to a licensed attorney, a licensed CPA, such as the ones that we have as guests today, to make sure you get the right answers. Also, this will be recorded. So if you miss some of this, if you have to log out early, we will have a recording of this, which will be posted in about a week. Or if you'd like to forward it to somebody who you think might benefit from having this, feel free to send a link along. We will get you a copy of that. We will take questions. I know there's going to be a lot of very, very good questions. What I'd like to do before you put your questions into the Q&A box, let's get through a lot of the content. Turns out we might answer a lot of your questions prior to you asking that. That's going to be the goal. Whatever we don't answer, we're certainly going to open it up to Q&A to make sure that we answer all the questions that we can. Okay, enough of myself talking. I want to introduce our panelists today. First off, we have Jennifer Jaynes, estate planning, trust, and probate attorney. We've got Ryan Lockhart. Ryan is a tax attorney. And we've got Chris Pasqua. I hope I said that. I just rolled off, right? Did I say that right?
You did great.
Okay, perfect. CPA. So we've got a very well-rounded group here. Jennifer, let's start off. Just give us kind of your brief background, and then we'll move on to Ryan. We'll move on to Chris.
Yeah, so I am a trust and estates attorney, a certified specialist by the State Bar of California in probate, trust administration, and estate planning. About half my practice is the planning portion, the estate planning, and then the other half would be the administration in the event of a loved one passing away, whether it's through probate because they didn't plan or through trust administration where we're just administering the trust as written.
Awesome, thank you. Ryan?
Good afternoon, everybody, or good morning still. I'm Ryan Lockhart. I'm a tax attorney. I'm certified legal specialist in tax law by the State Bar. And my tax practice touches a couple different areas. One is we consider high-end, high net worth individuals and families with estate planning. That's succession planning, but I also deal a lot with business tax issues and tax legal issues, whether it's transfer, reorganizations, et cetera. Property taxes is a huge area of my practice, and I actually quite like property taxes because I like to go fight the county sometimes. So it's fun.
Cavalier.
That's right. I'm good. That's me. I'm Ryan Lockhart. Thank you.
Thanks, Ryan. Okay, Chris?
Yeah, hi. My name is Chris Pasqua. I'm a CPA. I've been doing this for 20 years or so. And I've helped many individuals and businesses over the years, and I've found that 99% of the people I've helped have one or more pieces of real estate in their life. So there's always issues related to real estate. It's a great tool for generating wealth. And coincidentally, today we'll be talking about Prop 19, which affects all California real estate property owners. So here we are. And that's me in a nutshell.
Okay, thanks, Chris. And Chris, the background, I mean, I love the background. Can you scoot over to the side a little bit and show us your virtual background?
Oh, sure. Yeah, that's what happens when you leave a CPA alone in Maui. I just felt it was appropriate.
So
if you can't read my foot in the sand, it says I love taxes.
You must absolutely love taxes to be doing that on vacation in Maui. That's great. Okay.
Well, that's why I was in Maui. Taxes got me there.
Chris, let's get started with you.
Sure.
You know, people are talking about, you know, the benefit for most of people, what they saw on the ballot, the benefit of Prop 19 was to be able to take, you know, release some of the requirements for moving your property tax base to a different county. Let's start from the beginning. Tell us where we came from all the way to where we're at now with that component of Prop 19.
Sure. So just a couple things that I just want to touch on real quick is I'm going to give the history of Proposition 19 and kind of get everyone up to speed as to how we got to where we are today. And then I'll talk about the good parts of Prop 19. And then Jennifer's going to jump in and talk about the bad parts. And then Ryan will jump in at the end there and talk about some possible solutions that may or may not apply to your situation. And just one thing I want to touch on real quick, because there is a new administration coming in with the presidential election and Joe Biden. And there is the potential for some pretty significant tax law changes, such things as step-ups, 1031 exchanges. Those are on the chopping block potentially. There's talk of raising capital gains rates to the ordinary rates on incomes over certain thresholds, and potentially some other changes to real estate deductions for rentals and investment properties that will completely upend what we're talking about today. So given we only have an hour, we're just going to focus today on tax law as it stands right now. And so now that I've gotten that out of the way, let's go back to the history here. And so back in 1978, it was interesting. At that time, properties had been going up a ridiculous amount. I think in a 4-year period, they averaged about an 80% increase. And at that time, local governments could set the tax rates pretty much any way they wanted, within reason, of course. But Prop 13 came in 1978 to essentially eliminate that ability at the local level and just install a 1% roughly tax rate for all properties in the state of California. And the other thing it did is it limited subsequent increases to 2% or less per year. And now if you fast forward to 86, Prop 58 came into play, where it affects parent to child and child to parent transfers, where you could transfer your primary residence to your child or children and maintain that assessed tax base, regardless of the value of the property, without triggering reassessment. So that was a pretty cool little deal. It also put into play the ability to transfer investment properties like rentals and second homes and vacation homes up to $1 million per parent. So for a mom and a dad, that's $2 million total of assessed value that they could transfer over to their kids. Then also in 86, Prop 60 passed, which put into play, if you're over 50 or 55 or over, you could sell your home and transfer that assessed value into a new property in the same county, as long as the fair market value of the new property was equal to or less than the fair market value of the old property. And coming forward a little more, in 1988, we had Prop 90 pass, which some folks were like, hey, you know, I want to sell my house, but I want to live in a different county. So Prop 90 came into play in 1988, which allowed folks to sell their home in one county and potentially transfer it to another county that allowed those inter-county transfers. There's 58 counties in California, and right now only about maybe 10 counties allow this to happen as it stands right now. And then in 96, Prop 93 came into play, and that's really a mirror of Prop 58, the one on the parent-child transfers, except it allows for a grandparent and grandchild to transfer tax bases, as long as, unfortunately, the parents of the children have to be deceased. So now, jumping into Prop 19, you know, what the heck is it? Well, it was passed by California voters in November by a really thin margin, about 51% to 49%. And it really feels like it snuck up on folks, because a lot of us were just focused on the fact that there's the good parts, which were what put out there for the masses, but it felt like the bad parts, which Jennifer we're going to talk about in a minute, kind of felt like it snuck up on us. And when it passed, everyone went, oh crap. And so anyway, with Prop 19, there's really two main impacts to the proposition. And one is it allows a person that's at least 55, disabled, or a victim of a wildfire or a natural disaster to preserve and transfer their tax base to another property anywhere in California. And so that's the good. And I'll talk a little more detail on that in a minute. But then it also puts into play that property transfers between parents and children and grandparents and grandchildren, it'll only allow you to avoid property tax reassessment in very limited circumstances. And so most transfers that happen after February 15th of 2021 will trigger a property tax reassessment. And that's the bad. And that's what Jennifer will be talking about in a minute. And another thing that Proposition 19 covers is it protects farmlands, which is a whole nother discussion and not part of today's focus. But if there's any questions, we can touch on those later. So now, just in short, the good of Prop 19 is that it adds mobility and flexibility for seniors and empty nesters to be able to sell their home and sell a better home and sell into a better home, excuse me. And it just gives a lot more flexibility for folks who may feel trapped in their home as it stands right now. So now just to kind of jump in real quick on the good of Prop 19. So for folks that are at least age 55 and disabled, under the current law, you're allowed to sell your principal residence and then purchase a new home within 2 years within the same county or within counties that allow those inter-county transfers for an equal or lesser value. And then it's also pegged for inflation. So under the current rules, if it's within the first year after sale, it's 105%. If it's after the second year or during the second year, excuse me, it's 110%. And you get this as a one-time thing, except if you can actually use it for your age, and then you can do it a second time for disability. And for the code junkies out there, this is under Revenue and Taxation Code section 69.5, which will matter in a second. And this is going to be effective through March 31st of 2021. So this is going to be on the books for a little bit longer. And now the good of Prop 19 is where if you sell your principal residence and within 2 years you buy a property anywhere in California for any value, the amount above 100% is then added to your transferred value, the assessed value. And you can do this 3 times cumulatively in your lifetime. And this is going to take effect April 1st of 2021. And one of the things in the way that Prop 19 is worded, it says for people over 55, but I have a feeling the intention was for 55 and over, which is how the Revenue and Taxation Code 69.5 reads. But I'll defer to the attorneys on that one. I'm just a CPA. So now one thing just to touch on here real quick is, okay, that's all great. What does that really mean? So I'll just give a couple little examples. So the easy one is if you sell your home and buy another home for the same or lesser value, then it just, your tax basis just carries over. There's no change, that's easy. But let's say you have a home and it's worth the tax basis is 400,000 and you sell it for 900,000 and you want to just, upgrade a little bit. Your dream home is a little bit bigger, a little more expensive, but it's the place you want to stay and retire and live out your life. Let's say it's $1 million that you buy the new home. So what you do there is you take the difference between the fair market value of new home less the fair market value of old home, which is 100,000. So that's $1 million minus 900,000. And then you would add that to your existing tax base, which in this case is 400 grand. So you get $1 million home and have a tax base of 500 grand. And that's the really good part of Prop 19. And then just to kind of take it a little more and up the numbers a bit, in another example, let's say your home that you have now is worth $6 million and the assessed value is $1 million. And then you go and you find your dream home, it's about 8 million, let's say. So in this case, what you do, say 8 million of new home, 6 million of old, difference of that is 2. And then you tack that onto your existing assessed value of 1. So that gets you to a new value of $3 million as your assessed value. Also an equally good deal, $8 million home for $3 million tax base. One little thing that I'm finding folks overlook is the homeowners exemption. So make sure in your property tax bill that you see that little $7,000 reduction on your bill. That's the homeowners exemption. If that's not there, that's an issue, and all of this would just blow up under Prop 19. So just make sure on your property tax bill that you see that homeowner exemption on there. So in short, I'm going to now hand it off to Jennifer, who I guess drew the shortest straw and got the bad.
I don't mind talking about the bad because it is what is affecting my practice right now. Of course, it's always at this point, children and parents who have real estate who want to pass it to their children are calling trying to ask what to do now that Prop 19 has passed. And of course, now that Chris has talked about the good, well, that's going to decrease revenue for California, tax revenue from property taxes. And so where are they going to make that up? And where they're probably going to make it up per Prop 19 is having a negative effect on people who inherit property. And that's basically taking away much of the benefits, if not all of the benefits, of Prop 58 and Prop 193. Which allow for the parent to child and of course parent to grandchild transfers, where you can transfer your property to children or grandchildren in certain situations if the parent has passed away, and keep that same property tax basis. And this has been, since the 1980s when this has been allowed. And so it's kind of ingrained in planning and what we've been doing. Certainly since I've been practicing as an estate planning attorney, it's a huge benefit to children and grandchildren when they can inherit the property at their parents' or grandparents' property tax basis, and it can go down from generation to generation. And so people now could be paying property taxes based on what their grandparents were paying property taxes on if the property's been kept in the family for multiple generations. And so under the old laws with Prop 58 and 193, you could essentially, like Chris stated previously, you can transfer any value. It doesn't matter if your home is worth $1 million, $5 million, $20 million, $50 million. You can transfer any value of your primary residence to your children, and they still maintain that property tax, the assessed value of the property tax basis. For rental or vacation properties or commercial properties, it was $1 million of additional property per parent. So $1 million for deceased spouse and $1 million for surviving spouse. That's how I'm going to refer to them. So ultimately, it was a lot that you could pass to your children, a lot of different properties, because the assessed values on multiple properties could have been low. So again, I just want to reiterate that was on assessed value, not on the fair market value of these vacation homes or rental properties that you had. You could transfer $1 million of the assessed value, which would probably be pretty low if you purchased it many years prior. So now under Prop 19, in order to pay for the qualified transfers that Chris had talked about, where you're able to move if you're over 55, suffered from a natural disaster, or disabled, in order to pay for the loss in revenue there, we have kind of essentially removed parent to grandparent, grandparent to grandchild, and we've allowed for parent to child transfer.
Did we lose Jennifer?
I think she's frozen in time. Chris, do you want to follow with what her thought was there? I think you were following that.
Sure. Well, I hate to steal her thunder.
Am I back?
Oh, there we go.
Oh.
Say, Ryan, do you know how to juggle?
I apologize. I'm sorry. So it's one. So basically, you can transfer your primary residence. We got rid of the infinite value of primary residence that you can transfer, and now it's up to $1 million fair market value, and it's the difference between basically that you can reduce if there is over $1 million in over $1 million in the difference between the assessed value and the fair market value of your home, then it's going to get reassessed. And essentially you have $1 million that you can take off of the fair market value of the house. So if it's a $6 million house, then you're basically going to pay property taxes on $5 million. And that's only if the child moves in. If it was the parents, if it was the parent's home, primary residence, and then the child moves in, then they can pay that lower property tax basis, but it's not going to be the parent's assessed value. It is going to get reassessed if there's over $1 million in difference between the assessed value and the fair market value of the property. And then they essentially did away with any additional properties, vacation or rental properties. And so that's huge for a lot of clients, which is why clients are calling me now to see what they can do. Does it make sense to make the transfers now? And there's a variety of different things that you have to consider, and it's different for every family. So there's income taxes, there's estate taxes, and there's property taxes. So even though this presentation is about property taxes, the effect that the transfers will have on the other types of taxes that are out there needs to be considered when deciding whether or not you're going to make these transfers, which is one of the reasons why I think Chris is he's running a lot of the numbers. Does it make sense to make the transfers if we are going to have a step up in basis on the property on death? Because if you do gift property to your children, they take a carryover basis as opposed to receiving a step up in basis on the property, which would then therefore reduce any capital gains tax that they may have to pay if they sell the property. So the conversations need to happen as to, well, what do the children want? What do the parents want? And there's consequences for the transfers, right? So if you want to transfer your primary residence, which some clients will call me and say, you know, this is our only property, versus clients that have, you know, the primary residence and then multiple investment or vacation properties to consider. But if it's the primary residence, I mean, can the parents afford to gift that? And even if they did gift it, then there's certain issues that come up, like, do they have to pay rent to their children to reside in the property? And then what type of tax consequences does that entail in terms of, you know, gifting and income tax? You can't get something for free, unfortunately, and by for the IRS without paying some sort of value. That's and Chris can tell you all about that. But there's tax returns that will have to be filed, and multiple considerations when you're thinking about transferring property. And I don't want to step too much into what Ryan's going to discuss, which is possible solutions. And I'm happy to jump in. I know Ryan knows all these solutions, but we thought, you know, it might be helpful because Ryan and I do similar things to talk about what our clients are asking us to do. And I'm happy to jump back on, you know, and talk about that a little bit. But Ryan, why don't you talk about some of the things that you're doing and possible solutions?
Absolutely. Thank you, Jennifer. I don't think it's an understatement to say that the majority of calls and emails I've received since the election have been about this topic today. And the solutions that I want to talk about are really all tied to what Jennifer just went through very well, is that this parent to child change that Prop 19 is going to make. And I will echo what she said. We do have to look at the tax considerations. So the first thing that I am doing with clients is we are running this analysis, and I'm talking to the clients and the kids to see what is the plan. Because if the plan that the kids are, once they inherit the property in the future, are just going to turn around and sell it anyways, then we want to plan for the step up in tax basis. Trying to move the property now probably doesn't make a lot of sense. It may make sense if we have clear family vision that we have some properties in the family that we know we're going to keep in the family. Maybe there's some sentimental value tied to them. And so if those facts work out correctly, then we jump into the analysis a little bit more in depth. And so we do have to weigh, what is the step up in tax basis we're going to forego? And then what are the benefits we're going to get on this property tax savings? So quite frankly, the easiest solution, if all those boxes are checked and everybody understands, like, yes, it makes sense for us to transfer a property now, well, then we're faced with a timing issue. We have to gift the property, most likely a gift, from parent to child before February 16th, and let's just call it February 11th, because the 12th and the 15th, I believe, are holidays for the recorder's office. So we have like a little bit less than a month now. And what does that look like? Well, the simple answer is we just have to have the deed, right? A deed that's going to transfer title from mom and dad to the kid or the kids. But there's some other documents that I'm also doing with them, because we have to report this gift to the IRS, because as Jennifer said, we're also implicating gift tax. So normally when a taxpayer gifts an asset to another individual, in this case, parent to child, they have to either pay a gift tax, and that's a 40% gift tax under current law, or they're going to have to use some of their lifetime exclusion. So every person has a lifetime exclusion towards the unified gift and estate tax. Right now, on January of 2021, it's $11.7 million of exemption. Huge number, plenty of exemption for most people. But we still have to do that reporting mechanism. So there is going to be a gift tax return, as Jennifer said, that's going to be sent up to the IRS to elect the exemption amount. And we have to send some supporting documentation to the IRS to be able to justify what we did as far as the values are concerned. But as long as we get that deed in place, then it's a simple transfer, it's done. And as long as we get that recorded by that February 12th, let's call it, then the gift is completed and we're done. That's a simple solution that, quite frankly, I'm not finding clients that this is going to be the right case for them, because I'm running into situations where we have clients with only their primary residence, and they come in and say, we got to gift our primary residence to our kids. That's an issue. That raises some red flags. We have to discuss that. But we do have I have some other clients that have multiple other properties. And under normal times, prior to Prop 19 coming in, I would have done a lot of planning about these other properties to be able to transfer them using that $1 million of exemption that mom and dad have each under Prop 58. Since that is going away, there's some other solutions that we can start to look to. One of those is there's a whole other set of property tax rules that are going to be for entities. When I say entities, I'm talking LLCs, limited liability companies, partnerships, corporations, whether it's C Corp or an S Corp. LLCs are generally the most favored type of entity for real estate holdings in California, I would say. At least that's what I've come across.
Yeah.
And there's some different rules that say, all right, if an entity owns property, we can transfer up to 50% of the entity itself to a different individual without triggering a property tax reassessment on the properties that the entity owns. So let's say the LLC. I've used this technique quite a lot with clients in the past already, where we have a bunch of different properties that are exceeding that $1 million under Prop 58, where we can start transferring 50% of the LLC to the kids. So basically make it like a family run real estate holding company is really what it would be. And we can still keep the properties inside the family. But we're limited because we can only go up to 50%. If we go above 50%, then we can trigger a reassessment. So the solutions that are available aren't great because we have a very short timeline under Prop 19 to be able to do this parent to child transfer. We have about 28 more days to do this. That's pretty short, and it's going to be quick. This entity level rules that I just mentioned and went through, these are rules not implicated by Prop 19, at least as of yet. Let's see what the future holds. But so we have some time if we're going to do this entity level transfers that may make sense. We can also blend these two solutions together. So if we know we're going to transfer some property or at least some interest in property to the children in the next 30 days. For some clients, I'm actually taking the 50%, having them, mom and dad, gift 50% or maybe a little bit more to the children, applying Prop 58 exemption because we're going to be before Prop 19 comes in. And then we have mom and dad and the children roll into an LLC together so we can start taking advantage of the entity rules in the future. So there's some other rules that implicate this, but it does create some avenues of planning that can be done, even when Prop 19 comes into place. But again, we're still stuck with this deadline coming up. So we have to start to analyze this sooner than later. And I would definitely recommend if you have questions for your particular family or somebody you know for their particular family on whether this makes sense, it's the analysis. The analysis has to happen first because we have to know what are we trading off on the step up in tax basis, which is an income or capital gains tax question versus this property tax savings that everybody wants to try to find right now. But as long as we understand what the trade-off is, we can start to analyze and balance what makes sense in particular for that client.
Right. And I think, Ryan, you've hit on a couple good points too, in that, the analysis is important. So people calling their lawyers at the end of January and having multiple properties that may be in multiple different entities and or trusts. So a spouse has died and they've funded sub-trusts with like bypass trust, survivors trust, and marital trust. I don't want to get too complex in the discussion, but that analysis needs to happen way before the end of January. You need to look at it now and talk about some of the things that Ryan was talking about. Do the children want to keep the properties? Do they want to be, real estate investors? Do they want to be landlords? Do they want to be, dealing with that type? Because if you just wait, if the intent is to sell and cash out and you wait for inherited property, you get the step up in basis. Let's not talk about the Biden administration now, but if you get the step up in basis on death, they can sell it, have no capital gains tax, and kind of invest the inheritance themselves. So oftentimes children don't want to move into the home of a parent, or they don't necessarily want to continue to invest in the real estate. It just depends on the family. And so, yes, talking to your advisors and doing it soon enough, because we're already in a time crunch, is very important.
And just to add, I hate assuming things, but I don't know if the audience, if there's folks out there that don't understand, we keep saying the word step up. They even know what that means. And basically what it means is, when someone passes away, their assets can be revalued as of the fair market value at the date of their death. And so that's what the step up means. And presumably it would be a step up in the Bay Area, but there could also be a converse where the property's actually gone down in value. And that's an income tax concept, because that's the thing about Prop 19 is you could focus on the property tax piece, but it also, as Jennifer said, it affects estate tax, gift tax, income tax, financial planning, family dynamics. I mean, there's a lot of other things that Prop 19 touches upon to come up with a good decision. But jumping back to step ups, one of the things that if for example, the kids want to keep the property, if the property is fully depreciated, say it's a rental property and it's been in the family for 100 years, it's fully depreciated. There's nothing left on that thing. So its tax basis is zero. And now if you're going to gift that over to the kids or whatever, that tax basis, this income tax basis, is going to transfer over to the kids, so zero. So if they were to sell it, they'd be all gain. Whereas if the kids inherit the property or kid, they get that step up, and now all of a sudden, yeah, your property taxes are going to go up, but you're going to get a depreciation deduction that could very well offset the additional property tax that they're paying. And so that's where this modeling really helps at trying to do the cash flows and before and after. If we do something before Prop 19 kicks in, what does that look like on a cash flow basis? We do something after, what does that look like? And it's kind of surprising. You'll see that depreciation deduction can actually really be a game changer if they're going to hold on to it, as well as if they're going to sell it too. And yeah, I'm going to ignore the Biden administration potential getting rid of that.
Hey guys, real quick, I want to address a few questions that we've got here, and feel free, whoever would like to answer these, please jump out. Jim asks two questions. One is, are properties in trusts affected? The second part of that is, since this is a leaving the Bay Area group, what are implications if we do a 1031 for an out-of-state investment property now?
Chris, you can answer the 1031 question, but certainly these Prop 19 affects trusts.
Oh, absolutely. Well, 1031 exchanges are scrutinized. And so you better bet if you sell a property in California and you go to another state, California is going to be watching you. So, that's another one. It's a complicated question that the answer to it really comes down to facts and circumstances to your particular situation. So I think his name was Jim. If he has, I'd be happy to follow up with them and figure out more of the particulars. But California likes to keep things in California. And so
absolutely, they do. Another question comes from Linda. What city do you each practice in? And I think maybe what she means is what areas and cities do you service within your business?
Sure, I'll go first. I'm San Francisco based, but I help people all over the place and even overseas for that matter. So location really isn't a big deal, especially with Zoom the way it is now with this COVID thing we've all been dealing with. I'm anywhere.
Okay.
My
Jennifer?
office is in San Francisco, but all over the Bay Area, California side of Tahoe, LA, and San Diego.
Okay.
Ryan?
Ryan?
I am in Walnut Creek in the East Bay. The general Bay Area is my main focus, but I've helped clients all across the state. Yeah, no problem.
Okay, fantastic. On a side note, since we don't have the contact information for our panelists on the screens right here, you can always email us info@leavingthebayarea.com, info@leavingthebayarea.com. Happy to provide this information. And a question from Cliff. Can property tax rate be transferred if I buy a house before selling? So if he buys a house before selling, can the property tax rate be transferred?
Oh, yeah, absolutely. Yeah, you can do it backwards, absolutely.
Okay.
Just make sure that you do the paperwork.
Now, talk to us about that paperwork. What is that kind of from a high level standpoint? What does that look like?
Sure. Jennifer, you mind if you jump on that one? That's more your
Well,
wheelhouse.
It depends if you're doing it for the benefits of it or if you're doing it for the negatives. I do a lot of it for the parent to child and parent to grandchild transfers. So ultimately what ends up happening there is that there's a preliminary change of ownership report that you file, a parent to child exclusion form, a transfer tax affidavit, and you write the date of transfer. So I think a lot of this is depending on whether we get the transfers done before February 16th, if it's a parent to child or parent to grandchild. If you're going over the age of, if you're transferring your property tax basis to a new property in California, that is dependent on the assessor in each county and what you're going to file, but they are tracking them. So it's, they're tracking them in the effect that the BOE tracks them, the Board of Equalization, but essentially they're showing once you file the paperwork that you've already used one of your transfers and the reason that you used it. So obviously that's going to be an issue if you're trying. I've heard people say, well, how are they going to track it? The BOE does track it. And in fact, I've even emailed the BOE just recently, Board of Equalization, to get prior transfers from parent to child. And they have it all listed, and they'll just shoot you off an email that says, this is how much your client has used in the past. So it is tracked. I just don't know. The only thing that I don't know how they're going to track in the future is with Prop 19 parent to child exclusions, when a child moves into the primary residence and then doesn't want to live there after a year or two after they've claimed it as their primary residence. I don't know how they're going to track a child, how long a child keeps it, and the reassessment of that. So that's going to be.
I'll jump in here a little bit because I want to get this out there as well. Us professionals who are looking at this very closely, because it's in our practice area, we are waiting for some guidance from the Board of Equalization on several questions. And that's definitely one of them. That's one of the main questions I've been getting. How long does a child have to live in the home if they do move in? We don't know yet. BOE is known to be, let's just call it slow. So I don't expect guidance to come before February 16th. It could, but and also to answer your question, Scott, I would expect to be new forms that are going to come out. At least the BOE will propound some new form, right. And then each county does their thing and come up with their own form. But right. So some of this is we have to wait and see. Unfortunately,
not the best.
No.
But those types of things, the forms and everything, if you're doing it past the deadline in the enactment of the new law, that's not going to be an issue, right? Those are just like formalities and forms and administrative tasks that you have to complete, and you just have to do it right. And you can always ask questions. Like it's when we're filling out these forms, I can imagine, I'm not going to say that when new forms come out, I'm going to be an expert at them. I'm going to call the assessor office, or I'm going to figure it out. That's how it works. But the things that are important, which we've already been doing for a long time, is before February 16th for the parent child, we need to know the law. We need to know how to complete those forms, not get the deed kicked back. And that's something that we've been doing for a long time. So that's not really an issue, and it's not something that we're really learning. We already should know.
Not up to February 16th.
Yes. But after February 16th and all of that, there's going to be new forms, and we're going to figure it out.
Sure.
Another question here real quick from Jerry. Jerry asks, can parent just add a child to the deed without triggering a reassessment?
As a joint tenant, you can add well, if you want to do it now, you certainly can with a parent to child, right? So that's easy, right? But after February 16th, you could add them as a joint tenant without there being a change in ownership. And so that's the issue. But once the original owner passes away, which doesn't save you anything, then at that point, there would be a reassessment. So, okay. I mean, if you're going to consider adding a child, I think you would probably want to do it sooner rather than later.
Yeah, death is always a trigger of a reassessment, just in a short one-sentence statement. And another little thing that most likely would not apply, but who knows in this world we live in. But so if you have a property that has debt on it and you are going to be transferring ownership, make sure that there isn't any due on sale clause in there that may be triggered by a lender. Probably wouldn't apply, but you never know. So I'm just throwing that out there.
Yeah, some lenders won't lend to irrevocable trusts and things like that.
Yeah.
And sometimes even with LLCs, without there being a guarantor or cosigner or something to that effect. But yes, properties that have debt are limiting the types of transfers that can be done. Certainly, I've come to kind of realize, especially with the low interest rates that we have now, the due on sale clauses aren't really getting exercised if the loan's getting paid. But
Yeah.
They'll take their money.
Yeah, exactly. Yeah.
Just a reminder to all of our attendees, if you have questions, at the bottom of your Zoom screen, you will see a box towards the center that says Q&A. Feel free to answer questions here. Let's stump these guys, right? Let's get them really thinking. Jeopardy style. And, what else do you guys want to maybe mention? Any tips, tricks, ahas, things like that?
Tips, tricks, and ahas. Okay, so I think ultimately, I think the best thing that you can do is well, we don't even need to deal with the over 55 and all the good news. That's good. Everybody can take that and be like, yay, my parents can move from this house that's too big for them or that has stairs into a different property and keep their property tax basis. Because I know that was causing a lot of people to stay in homes that weren't necessarily appropriate for them because they were paying so little in property taxes. If you have property and you're considering on giving it to your children, we did say this before, but doing the evaluation, and in some cases it just doesn't make sense. As Chris was saying, we don't want to scare you. Like, you have to do all of these things. It's just Prop 19 is a tax law that is here now. I don't know if it will be here forever. Tax laws has changed all the time, but it's here now and we can deal with it. It's just that you have to give yourself enough time to evaluate the situation. And in some situations, my clients are not doing anything. They are just saying, okay, we've now assessed it. I can tell you when my clients are doing something, and it's usually when a spouse or a parent has passed. There is a surviving spouse. You get a step up in basis on the death of the spouse. So now all of their properties are at current fair market value. So we've taken away that issue about step up in basis on death because one spouse has passed away. And so at that point, we now have a new basis, which is current fair market value, and they may be gifting those assets to their children. And only if they don't need the income or they're not living in the property, not everybody has the wherewithal to be able to give property to their kids outright while they're alive. They may be living off the rental income. And so I think in that situation, you really just have to evaluate things. And most of the people that are doing the transfers either have a taxable estate, need to get assets out of their estate, had a spouse recently die and recently getting the step up in basis. And the children are older and wanting to manage the property for a long time.
Sure. I mean, and if you've got a rental property and it's cash flowing and you're using that cash to live off of, which is very common, and you do decide that transferring over to your kids makes sense, of course your kids are going to gift the cash back to you. They would totally not hang on to it. I'm being facetious, and that's the point of it, though. Is it's you can look at it from the property tax side of things, but there's also the income tax and the practical of, do you want to have your kids, being responsible for getting money back to you if you truly need that cash flow? So just a thought.
We've got a couple more questions here. Dennis asks, my parents passed away recently. Their attorney intends to transfer title to their primary residence to their siblings before February 11th. The siblings intend to sell this property and not live in it. Will the siblings receive a market assessed value as step-up basis for calculating the taxable gain/loss to the siblings when the house is sold?
They'll receive a step up in basis because it's inherited property, but you wouldn't keep the property tax basis. I mean, if they intend to sell it, it doesn't matter.
Exactly.
It's a specific situation. I don't know. Normally, siblings are not the people who inherit the property. So if it was via a will or a trust that they left that property to the siblings, but they will receive the step up in basis and not pay capital gains tax. They won't keep the property tax basis.
Okay, awesome. A couple other questions here. George asks, if the new home fair market value is less than the sale price of the old house, is the new property tax based on the old assessed value or the new?
The old one.
Right,
Assuming it's
so,
not more than the
yeah,
new property.
Right, right. So if it's under current rules, then yes, it would be the old property's assessed value would be carried over into the new property. And effectively, that's the same answer for Prop 19 as well. If it's your home and you live in it and all that.
Okay. Jess asking for contact information. Yes, we'll get that over to you. Jim asks, clarifying question. Does surviving parent reassessment happen currently, post Prop 19, or both? Is his investment in primary residence?
So the surviving spouse, Prop 19 does not affect the exclusion from reassessment between spouses. So it's just parent to child, parent to grandchild. So surviving spouse would keep the property tax basis as was before when a spouse passes away.
Okay, thank you guys. And Jim says, got it, thank you. Let's see here. Another question. If the 2 years passed for a new purchase during COVID and COVID prevented the seller from making a purchase, is it possible to still use Prop 19 now, or is that seller out of luck?
That is a really good question.
Let's hope they can do that.
Yeah.
I don't know.
Is the jury still out on that? Maybe don't have direction on that yet?
Yeah,
There's nothing that comes from Prop 19 that says they're going to do this, but
Exactly. Yeah.
BOE could elect some sort of relief
Right.
when it comes to this type of particular situation, but that's
Exactly. I mean, given we're all in lockdown still and for the foreseeable future,
Mhm.
I would hope.
Okay. Okay, excellent. This is fantastic. Maybe we'll see if we've got a couple other questions that come up. Any final thoughts or words of wisdom that you guys want to throw in before we wrap things up here?
Be nice to your advisors and give them enough time.
Start early, right?
Well, I mean, it's, yeah.
As early as we can.
Yeah.
As early as possible, for sure.
I mean, it just wasn't fair. The timeline was thrown into play here, which is not fair.
Yeah, why does the good part get all the way till April and we only get the bad part
Exactly.
only gets
It's
till
the other way
February?
around.
That just doesn't seem to make sense.
You know the answer to
yeah,
that.
We all know the answer to that. Absolutely.
But yeah, just in terms of final thoughts, I mean, yeah, not to sound like a broken record, but it is all really case specific, and what works for your friend who you talk to and they tell you, oh, this is what we're doing, might not necessarily apply to you. And so seeking that advice from a professional can really walk through the details and figure out what does actually work for you. It's what I call cocktail talk.
Yeah, and I would say that most of the ones that I've analyzed with clients that in the last month, we're actually not doing. After we've gone through the analysis, they decided doesn't make sense. The ones that we are doing, just like Jennifer said, we did get a step up the tax basis because one of the parents died in the last 5 years. And the property's been held for so long, and there's clear intent from the children to maintain that property for a very long time because it's like family legacy property.
Sure.
They just really want to keep. So, again, we'll just see if it makes sense for you.
A couple follow-up items here. As I mentioned before, if you'd like to get contact information for Jennifer, Chris, or Ryan, email us info@leavingthebayarea.com, info@leavingthebayarea.com. Jeff asks, will we receive a recording of this webinar? Well done. Thank you, Jeff. Well done to our panelists. Yes, the email address that I just gave out, this will be posted on the website in about a week. To get a direct link to that, which again will be available in about a week, email us at info@leavingthebayarea.com. We can put that together for you. Jim, thank you for the positive feedback. We appreciate it. George has a question. If the assessed value of the new home is less than the assessed value of the old home, what is the property tax based on?
Old home.
Well, you wouldn't necessarily, if the assessed value, of the new home, meaning like they just purchased a new home for a lot less than what they had before.
Yeah, so
And
they
the-
stepped down
They
and
stepped
wanted
down.
to hang on to some cash and use that to live off of.
If
My
they don't,
understanding is
yeah,
based off the old value.
if you filed the paperwork, but I don't know why you would file the paperwork. If you're just buying a new property in California and the fair market value of that and your property tax is based on 1% of the fair market value and that's less than what you were paying at your old place, then don't file the paperwork and take advantage of that.
That's my passive aggressive way of answering the question.
I don't know if that made sense, but I was just like, if your new property tax basis would be less than your old property tax basis, then you just take the new property tax basis.
Exactly.
Sorry.
Yeah, Prop 19 is an affirmative election, so you don't
Yes.
have to take it.
You don't. Yep, exactly.
We've got about 5 more minutes. If we have any other questions, feel free to put them into that Q&A box.
One thing I'll follow up on, because there's an earlier question and Jennifer answered about, does this impact trusts? When it comes to property taxes, the county assessor looks through trusts to see who the beneficiaries are. They call it beneficial ownership. So you can have revocable trust, which definitely is the beneficiary and the people who own that trust. When we're talking about irrevocable trusts, it can get complicated, but they will look through see who the current beneficiaries are. That's the beneficial owners. So you can have trusts where there's multiple generations as beneficiaries that can cause problems. Also, like when I mentioned rolling into limited liability companies, et cetera, same kind of thing. If you have trusts that are members in those LLCs, it can get complicated, but the county has their process. They're going to look through those entities, through those trusts specifically, to see who the beneficiaries are. And that's how they're going to start their analysis on the transfers that might be happening. So if there's a trust that's out there, like a bypass trust or a marital trust, those are irrevocable trusts. They're going to look to see who that beneficiary is and if they even have the capability of transferring.
Well, one comment too is because this has all been rushed and it is extremely complicated, there's a lot of bad information out there, unfortunately, and on the internet. So when you're doing internet searches, you might be getting answers that aren't actually true. And it is an evolving thing. You know, I feel like I'm learning more and thinking of different things each day. And in the meantime, that deadline is still the same and it's looming. And it's a bit frustrating, but just be aware. There's some bad stuff out there. So
Yeah, and
Absolutely.
ultimately, if it's complicated, and in some of my cases it is, we changed our strategy like 3 or 4 times before we finally arrived at the strategy that we're going to use. And my client in that situation is watching all of these webinars and keeps coming back to me. Well, what about this? Well, what about that? You know, it is hard because there is a lot of bad information out there, and we have to pick a strategy and we have to move forward with it because there is a deadline. So just be wary of what you're hearing or reading on the internet.
A lot of this seems
advisor.
to be open to interpretation because it's so new. There hasn't been a lot of clarification from the oversight boards. But yeah, you do have to make sure that you're talking to somebody who has a consistent understanding of it and is really working in it daily. Jerry has a question. Do you recommend placing the primary residence in a LLC?
Normally that would not have a valid business purpose, so no, I don't really recommend
No
putting a
reason to.
primary residence in
Yeah, I
the
generally say
LLC.
no as well.
I mean, maybe if you're like doing some massive construction project and you're afraid people are going to get hurt and killed, but then you shouldn't be doing that in the first place.
Insurance.
Exactly. Yeah.
Insurance, the best asset protection.
Exactly.
Okay. All right. Well, Jennifer, Chris, Ryan, this has been fantastic. I mean, you guys really are just a wealth of knowledge on this topic and a lot of other topics. And I appreciate your time. I know that all of our participants do as well. So thank you all so much for doing this.
Thank you.
A
Thank
really
you
big
for
help
having
a lot of
us.
people.
Yes,
My
thank
pleasure.
you. My
Fun.
pleasure.
Maybe what we'll do, as we talked about before, as we get some direction on what's going to change with the new administration, maybe we'll revisit this in a couple of months, right? Have the same conversation potentially on branch off in a couple of different topics that maybe are related a little bit. But obviously we're going to see a lot of changes, and boy, it's gonna happen fast, and there's gonna be a lot of misinformation and a lot of misunderstanding. And so maybe if we can help clarify
Right.
for that, and we've got a few people, attendees who are saying great ideas. So we'll put that together.
Yeah.
So we'll see you all again.
You got it.
Exactly.
Okay. All right,
And as
guys.
the court cases start rolling out.
Thank you
Thank
all
you.
again, and thanks to all of our attendees for joining us today. We will see you on the next episode. Take care.
All
Thank
right.
you.
Take care, everybody.
Bye-bye.